It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Caution dominates trading in Asia ahead of a flurry of global inflation reports set to influence monetary policy. Chinese property firms in focus on fresh easing measures. Shanghai lowering down payment ratios and the minimum mortgage threshold.
And I'm David Ingles at the UBS Asian Investment Conference taking place here in Hong Kong. Lots of conversations coming up around the theme of India and elections there, of course, as we count down to the result that markets are bracing for. So perspective really, and you might know who they are, perspective from two leading economists who've had skin in the game. We had the former RBI Governor Raghuram Rajan joins us in a couple of minutes, and later on in the show we'll also be joined by the former Chief Economic Advisor to the Modi government, KV Subramaniam.
That's right. Both holding different views on whether policies adopted by Modi are right indeed. Let's do a check-in on how markets are faring. Avril Hong on top of that here in the Lion City. And Avril, traders pretty much sitting on the hands waiting for data.
Yeah, waiting for what we're going to get out on Friday, not just the Fed's preferred gauge of inflation, but also those China PMIs. We started the day with stock benchmarks moving sideways. Don't forget, we also have the US that was on holiday, so we're not getting that typical direction, but a bit clearer as the session progresses. The Hang Seng, that's been very sentiment-driven. I think there is a bit of positive news coming through based on what we're seeing out of Shanghai. The property easing there, along with yesterday's announcement of that chip investment fund, tens of $billions in that direction. The Japanese assets are also in focus. We got services PPI out of Japan today, and it shows that broadening of inflation, making the case for the BOJ to hike rates again. Certainly that seems to be the expectation. Take a look at where the yield on the 10-year is, still sitting above the 1% handle. Stocks in Japan coming under pressure today. We're seeing the yen also pulling further away from the 157 level against the greenback. Of course, this is against the backdrop of a softer dollar. Let's flip the board and take a look what else we're seeing in the FX space. Not that big of a move, all things considered, but there is an undercurrent here. When we saw yesterday euro dropping to a 9-month low against the pound, this is after one of the governing council members kind of went against the grain and said, you know, maybe not so unlikely that we see consecutive rate cuts. June was penciled in, but July is the big question. So this is what we're seeing in the FX space today. Has.
Well, that's right. Avril Hong, analysis now on the FX markets with Charu Chanana, who is Sexo's global market strategist and FX strategy head. Charu, good to have you with us. Of course, like Avril mentioned, not much to talk about in the FX space right now. Traders waiting and seeing to see how data comes out. But suffice to say, receding bullish bets on the dollar.
Yeah, I mean, we've seen that even with stronger data coming out, the top in the dollar seems to be capped a little bit. So certainly the question is, how much higher can it go from here if we continue to get that narrative out of the Fed relating to the higher for longer? But do I get on the dollar bear train yet? I think the answer to that question would be a no, especially because we are getting into this slow summer season where, volatility levels are super low already and likely to be, sustained to be lower. And that means carry trading continues. And dollar, given the high yield that it is providing right now, I think it's likely to remain in favor, at least supported at these levels for now.
Markets divided whether the Fed will move once or twice this year. Of course, Solomon of Goldman says none at all. Does it matter whether it's one or two on where the dollar heads from here?
Certainly, I think that plays a big part because the market has also been, still positioned for that Fed put. Even when we get that stronger data, yes, we've pushed back those expectations of rate cuts, but the messaging from Fed Chair Powell has been dovish. Even though I would say there's a divergence happening in the Fed committee now, and the other members have started to tilt a little bit more neutral to hawkish, preaching high for longer, as I said. But certainly, if there is a clearer acceptance from Powell about the potential of rate cuts, I think there's quite a bit of downside there for the dollar in that case.
People are talking about how the euro and the pound positions are shifting versus the dollar. What are you seeing?
Certainly, the euro positioning has been penciled in a lot because of that June rate cut, which has been priced in almost fully, right? I think the big question for the euro is what happens after that. We've seen the eurozone economy stabilizing a little bit. Is the ECB June rate cut a policy mistake? I think that's the big question. Can it really loosen financial conditions and bring back inflationary pressures in a big way? I would be really concerned about this move from the ECB, and the move in the euro is only going to come after we see the narrative out of that meeting. I think there is a little bit of a shift happening in the ECB committee itself, where they are a little bit more balanced about the policy direction post that June meeting, and they are preaching again data dependence there. I do think the euro will wait for that narrative to come out to react to that. Sterling, I think, is a pure risk sentiment play right now. It's the way the US equities move that impacts sterling more than the yield divergence.
Given your base case, how would you be playing the majors right now?
I think, particularly, like I said, I still think that in the next few summer months, carry trading is going to be the big theme. I think that certainly means that I stay bearish yen. So for me, dollar yen is a buy on dips. On the positive side, I think sterling, like we discussed, right, risk sentiment, as long as volatility is low, risk sentiment stays upbeat, and that helps sterling. So I would be, still looking at sterling. But I think the big story is really around the Aussie dollar, which is getting the benefit of this risk sentiment, but also all these policy measures that we are seeing out of China. So Aussie dollar, Kiwi dollar potentially as well. I think they are looking like they are potentially on a path of upside here.
And speaking of China, PBOC remains pretty patient and wants to see what the Fed does.
Yes.
Right? So what happens to the yuan from here?
I think PBOC is in a bit of a difficult situation because we've seen this increasing narrative out of the G7, where they are highlighting concerns about China's overcapacity. And China has really just that export engine that is kind of supporting the economy right now. When you're in something like a balance sheet recession at this stage, exports is something that they need to kind of continue to power ahead with. And for that, they do need a weaker yuan. But if they were to kind of go for a measured devaluation here, that whole G7 narrative against China's export push could get even stronger. So it could bite them back a lot harder. So I think they have to be a little bit more careful around their policy on yuan, and I expect a very stable, outcome there.
I wonder if it's justified for the yuan to be lower from here. You talked about the trade tensions, the G7 finance ministers calling out China in terms of its trade policies. We also have underwhelming support for the economy, property support notwithstanding. Does it justify a weaker currency?
Fundamentally, yes. Again, from a yield differentials perspective, from the perspective of the fact that, Chinese central bank is likely to be more dovish. They are still in a deflation. They need that support for the economy. And given that they want to push the export engine, it certainly makes sense for a weaker yuan. But like I said, right, they don't want those trade tensions to bite them even harder at this stage. So I don't see a rapid deacceleration there or a move that could really devalue the yuan in a substantial manner in a short span of time. So that devaluation, I think, will be in a very, very controlled way.
You talked about carry trade earlier on. In terms of Asian currencies, what's the best carry out there?
In Asian currencies, I think INR is looking pretty strong. Their growth inflation story is looking like they don't need to cut rates anytime soon. They can potentially postpone rate cuts to later this year, if not the start of next year. So that continues to give them some strength. And just that it's been the realized wall in INR has been so low, despite the fact that we are in an election. So as we kind of get through that election period, I think volatility is likely to remain slow. And then I think election risks in Mexico and South Africa are quite big as well. And we could see those carry trades being transferred onto Asia, particularly into INR as well.
So I'm not talking about an upside to the INR simply because we've had the RBI coming out with a bigger than expected dividend. And then there's also fiscal stability in the country. Both factors support a stronger currency.
And not to forget the listing of Indian bonds in the JP Morgan bond index. And that is also creating some inflows into the Indian economy, and that is also supporting the outlook for INR. So I do think that we are getting past those election risks. I think there is some amount of still, to see that the election outcome, what happens there, and if Modi, does he get the kind of majority that he expected to. But after that period of volatility, I do expect INR has a strong momentum.
What if Modi fails to get the majority he is after? How much impact might that have on Indian assets?
I think the markets have already started to price that in somewhat, right? I mean, he was aiming for 400 plus kind of seats, and there is now a realization that that target has been very high, and it might not be achievable. There could be some more risk coming back on the table, especially if he's not even able to reach something like a 350. But the structural story in India is so strong. You look at demographics, you look at the manufacturing upskilling that they're doing. There's a lot of good structural tailwinds that the Indian economy enjoys. So any of these pullbacks in the Indian markets are actually an added reason for investors to kind of get a participation in that market.
For India, it's also about the bond inclusion. Some say that a lot of it has already been priced in, but if all the factors come together, there's still further upside for the Indian government.
Absolutely. There's the headwind that I see really for the Indian markets would be whether those flows that came from China's slowdown go back into China. I don't see that happening yet because, again, China, as much as it is a tactical story, structurally we still haven't addressed the property sector issue. We still haven't addressed the demographics issue, which is obviously a very long-term problem that the China economy faces. But unless that reverses, I think the structural story in India stays quite strong.
Before we let you go, Charu, of course, T+1, any impact of that as we track the US coming back from that holiday?
I think some amount of volatility, yes, to kind of see how that really plays out. I do think, coming from an FX perspective, some of the flows could get transferred from equities into FX as people wait for that change to kind of settle in. But over the long term, I think it does mean increased liquidity, and that is just good for the markets.
All right, Charu, great to have you with us. Charu Chinana, Saxo's global market strategist and FX strategy head. Well, still ahead, insights on India's economy and markets from Mirae investment managers and the IMF. We'll discuss the implications of a possible third term for Prime Minister Narendra Modi later this hour. Keep it here with us. This is Bloomberg. Welcome back. The UBS Asian Investment Conference is underway in Hong Kong this week with a focus on key investment debates from inflation to AI. Let's get back to the conference where Bloomberg's David Inglis is with our next guest. Dave, take it away.
Yeah, and certainly inflation has been a key feature, which I guess is an understatement of our conversations in the last few years, few days. I'm losing count, really. And here we are, thinking, are we any better off than when the Fed started hiking interest rates nearly a year in since the last hike, So they're actually 10, 11 months into this. Joining us here, of course, on set is the former RBI Governor Raghuram Rajan, of course, and the current professor, of course, Chicago Booth School. I mean, we'll talk about India in a moment, but on the topic of has the Fed done enough? Have we not waited enough? Is it restrictive enough? Where is your head in all of this?
Well, big question. If you look hard, you can find some signs of slowing, right? You can see, for example, that some of the riskier borrowers are starting to confront higher interest rates. You're seeing downgrades, for example, start to increase to a level which we haven't seen for some time. You're seeing credit card defaults starting to pick up. And you're seeing, some slowdown in the pace of sales growth. So all this is good news for the Fed because it means that we're getting that kind of soft landing data that it's looking for. But if you look at, the single biggest way they have effect, it is through financial conditions. Financial conditions are back to the levels they were when the Fed started tightening. And remember, they were pretty easy then.
Right.
So the question that the Fed has to pay attention to, of course, last month's inflation data was comforting. but are they in restrictive mode? And part of the reason is the usual channels through which Fed policy works, higher interest rates, working through debt to slow down activity, or working through savings to slow down activity, don't seem to have effect. Household savings are, have fallen actually rather than increased. And you can see, from the debt side, 30-year mortgages aren't being affected, of course, by these higher rates because people are staying on with their mortgage. They're not borrowing anew.
That's right.
And of course, companies during the pandemic pushed out the duration of their debt and so aren't recontracting debt at these higher interest rates. So, the effects are, long in coming, and the Fed at some point is going to start getting worried. Are we restrictive enough?
If not already.
Absolutely.
And you make a very good point. I think you started by saying if you look hard enough, you will see the rate-sensitive sectors listening. So in that case, that started to take effect. But it's really on the part of the inflation basket that doesn't seem to be listening to monetary policy. What does a central banker do in this scenario?
Exactly. And the key question really is which aspects of the inflation basket are still worrying. And of course, services are a big worry. The rental component is also a worry that has started showing some signs of decrease. But of course, rentals in real time are starting to push up again. So I think it all hinges around the labor market. With the household feeling comfortable about employment, with strong employment still, I think you aren't going to see a slowdown in consumption. And that's really necessary. I mean, everything sort of hangs together, but some labor market slack would be necessary to give the Fed enough confidence to start reducing interest rates. Until that happens, I think it's guesswork whether inflation will come down much further. They have to be in data watch mode rather than anticipatory mode.
Which was what Olivier Blanchard, who was, of course, on your panel just now, was here and said a few minutes ago, talked about how the labor market is still on the hotter side of things. So I guess let's make it simple. Do you think the next move from the Fed is a cut or a hike? A cut or an interest rate hike?
Well, I'm going to give the economist's answer. It depends it depends on the data.
Okay.
My sense is if they see some genuine movement downwards in inflation, if owner-occupied rent, if that starts coming down, which they've been waiting for a long time, if everything seems to be moving in the right direction for a few months, they may have the confidence at that point to cut. The last thing what they want to do is cut and then see inflation perk up once again. The real problem, of course, is, by rates, they look restrictive. By financial conditions, they aren't. And which one do they believe?
And do you think, how do as a former monetary policy implementer, let's put it that way, how would you address that? Do markets have to be part of the mandate in some way?
Unfortunately, I think the Fed wants to have it both ways. It's been, it has hiked rates reasonably fast to a high level, but it also wants to give the markets hope that rate cuts will come. I think it should stop talking about rate cuts and just say, we'll take what it takes. I mean, you hear that, but you hear also, certainly at the beginning of the year, the cuts are coming. And that gives the market hope, which then makes financial conditions easier, which makes the Fed's task harder. So I would stop talking about rate cuts at this point and say, well, we'll do it when we do it.
Every meeting is live, and
Exactly.
we'll see. I want to ask you about India. Elections results are coming out. In the event, and it's a tail risk, in the event we don't get a third term from Prime Minister Modi, do you think the infrastructure push is at risk?
I think there's a lot of continuity built into Indian policy. And so my sense is, whatever government comes in will take a lot of the good stuff that's been done and continue it. I think, of course, over time, they will have to, look at where they push. But certainly, I think, there's a budget due soon after the election. My sense is, for the most part, it will be a budget that pushes on all the good stuff that's happening while trying to see what other changes have to be made.
when you look at the numbers that the government is trying to push through in infrastructure, what they've built, what is coming online, and I think our colleagues at Bloomberg Economics have a number in the order of about $500 billion, if I'm not mistaken, US dollars of infrastructure that's coming on in the next 2 years alone. Is affordability an issue that you ever entertained, for example?
I think at some point you will have to look at the quality of the infrastructure that's been built. Not so much the physical quality, but do we really need one metro for every city? Or is it okay if we stop at the big cities and so on? So I think there will you will have to look at it to make sure you're not over-investing in infrastructure. But I think India's big deficiency so far was, in fact, infrastructure, which is being remedied by this push.
The critics would say the infrastructure push is geared towards benefiting the middle class and the rich, the sort of glitzy projects, and not so much the poor. Is that a view that you think that resonates with you? Or
I think some of the elements of the infrastructure push will be taken up by big steel firms, for example.
Okay.
I don't think that is the primary intent. I think it is a genuine push in improving the quality of infrastructure. Of course, going forward, I think India does have to examine whether too much of economic activity is concentrated in too few firms. I think the answer to that is to level the playing field, to make sure many more firms have opportunities, both domestic and foreign.
Do you think the GDP number, and us in the media, of course, every quarter, this is something we obsess about, maybe, and sometimes over-obsess over. Do you think the growth trajectory we see on the headline level for a country this complex and this large, do you think that captures the economic story?
I think the 6.5% tag to GDP, which is what people expect over the next year or two, is quite reasonable. That's probably what India is growing at. I think the nature of that growth, a little too much towards capital-intensive growth, a little too little towards creating more jobs, that needs to be examined. But broadly, I think it also needs to be increased. 6.5 is too slow for a country with the kind of population dividend that India is experiencing, young people entering the labor force. We need to figure out how to get them jobs, productive jobs, so that India can not only employ them, but also up the rate of growth maybe to 8 or 9%, which is where we should be given that dividend.
Right, so suffice to say that's your view. 8 to 9% is what should be the potential growth of the economy that doesn't create inflation problems?
I don't think it will. I mean, look, where does inflation come from? From too constrained a supply. I think if you push for 8 and 9 today without enhancing the quality of the supply, you may run into inflationary problems. But I think there's a few small changes in improving the quality of the labor force, making people more employable, the kind of apprenticeships, the kinds of training programs that we're talking about, could actually increase supply to the point where it is not inflationary, and you can manage that kind of growth. Today, if you do it, you will run into labor shortage problems.
And you mentioned jobs as a sort of a weak spot, let's put it that way. What's the gap there? What do you think is not happening?
The gap is skills.
Okay.
Again and again you hear from firms, yes, we have a lot of people, but are they skilled enough to work in my factory? And you're seeing where the jobs are coming, for example, in manufacturing, are in the southern and western states, where there are a lot of women available to work. They're skilled, and the work environment is such that they feel they can actually go to work. And so you are seeing a lot of success there. We have to make sure the rest of India has the same kind of success.
Right. And is it worrying to you that, let's say the percentage of jobs that you're seeing in agriculture, for example, is going up? Should that be going up given where India is in its development cycle?
Absolutely not. I think it is an indication that we're not creating enough good jobs in services and manufacturing. We're seeing jobs in construction go up. That's part of the infrastructure push. But we absolutely need to enhance the number of jobs outside of agriculture. Now, agriculture, temporarily may go up, but the sustained movement over the last 4 or 5 years, I think, is a source of worry.
Just very quickly here, on monetary policy, not so much in rates. There's a lot of inflows into India because of this bond inclusion that's taking place. There are conversations whether the RBI needs to include forex intervention as a direct tool? Do you think they should, very quickly?
I think the RBI has always used forex intervention to reduce volatility, but not to establish a level for the exchange rate. I think it should continue doing that. I presume it will continue doing that. The level is established by so many other things. But for the RBI to try and fix that level, I think is very dangerous, and it's never done that.
We don't want to go down that path. Raghuram Rajan, thank you so much for your time. Former RBI governor there, of course, Chicago professor. Has, back to you in the studios.
Welcome back. China markets just heading to lunch in a moment. CSI 300 index down about 0.3%. We're keeping a close watch on banks in particular after Xi Jinping called for financial regulation that has a bite, and that's to reduce financial risk as well as hidden dangers. We're also keeping an eye on chip stocks in particular, still in focus after China announced a massive semiconductor investment fund to propel its own chip sector. It's the latest move towards self-sufficiency. Take a look at that. Benchmarks pretty much in negative territory. Shenzhen Comp currently down by 0.5%. And when it comes to the Chinese yuan, it is trading at 724.60, pretty flat versus the USD. Elsewhere in the market, of course, trepidation as investors await a slew of data. For the moment, let's do a check on how Japan might be faring. It is coming back from lunch. Avril Hong is on top of that. Avril.
Yeah, we're seeing it negative across Japanese assets as well, but for slightly different reasons from what we're seeing in China. We did get services PPI out of Japan today, and it shows a higher than expected climb. So that seems to suggest that inflation is broadening out, and especially in light of comments from BOJ officials yesterday, investors are betting we're going to get more hikes from the BOJ. That's being reflected in some of the growth names as well as the stocks that benefit from a cheap yen, such as Toyota. Your materials, your banking related stocks, they're helping to offset the losses on some of these growth sector stocks. So the Nikkei is down, as is the topics as we return from lunch. The yen is stronger, but keep in mind that it's really hard to fight the carry trade. So it's still hovering at relatively weak levels against the greenback. The yield on the 10-year still sitting above that 1%. Let's flip the board because this has implications if you take a look further along the curve at the 30-year. And if you're seeing those expectations about Japan to hike and China to ease, that's being reflected in the spreads. Tightest in 15 years should be something that's good for Japanese financial stocks, not so good for the ones in China.
And April, when U.S. markets return, they'll be trading at the fastest in about 100 years. What's that about?
Yeah, this is a system change that we are bracing for, and this is due to a change in securities regulators' rules. We're actually seeing potentially the transaction times about halved. This is previously something that we last saw in the 1920s. Now, this system would mean that these trades in New York, they're settled within a single day. So very, very fast in terms of settling the transactions. But there are teething issues that we are going to be watching out for. I mean, keep in mind that with things happening so quickly, it begs the question, if there are errors, will there be enough time to get them fixed? Keep in mind as well, there are some concerns about whether there's enough time for investors to be sourcing the dollars in time. So we're going to see very fast transaction times, but there are some concerns lingering still.
Brace. Avril Hong, thank you. Now to India, and foreign investors are already piling into Indian bonds ahead of the inclusion in June in JP Morgan's key emerging market index. For more on what this means, let's bring in Mirae Asset Investment Managers fixed income analyst and fund manager Kruti Cheta. Kruti, good to have you with us. Just a month away, and of course we've seen passive inflows making their way. In terms of the part of the curve that's looking attractive, what are you betting on?
So we've always seen that foreign investors, the investors always want to front run, and like you rightly mentioned, we've seen that there has been a lot of participation. $9.5 billion already come into the bond markets, and this money largely has come into the belly of the curve, which is your 2028 to 23 segment. More also for the reason because these are the securities under the FAR route where the maximum investment is allowed by the FIIs. So we've already seen that from there on till now, the yields have moved around 25 basis plus. Now we are just a month away from, not even complete month away from the inflows that are expected. From here, we expect that there could be two ways. One is that FIIs decide to stay and the steady flows continue into the market. From there on, we will see that the yields will ease as the market participation increases. But in case these FIIs decide that since the inflows have come in and they try to exit and book some profits on counterparting these inflows in the past, then we might see a slight correction in the markets with these flows coming in.
So a lot has already been priced in, Kruti. In terms of yield movements, what other factors might come into play? How about the Fed's higher for longer, for instance?
So for global, yes, there is a tough situation for higher for longer, and the central banks are also, RBI is also playing on that higher for longer with the Fed as of now. But domestically, the situation remains very healthy for us because we have inflation within the target band. We have fiscal consolidation for last 2 years going on, and for the third year also, we are going towards the fiscal consolidation. And as we've seen, this current regime has not surprised, failed to surprise us on the positives. So we've already seen that to manage this through the liquidity, we've seen some government buybacks. We have seen that there has been reduction in the T-bill issuances, and in the new budget, if there is, and we've seen RBI dividend also coming in higher than double of what the expectations was. So if there is a more positive to come in the new budget, we would not be surprised on the yield fronts, and we would see that there could be more positivity relating to the India fixed income markets.
The thing is, Kruti, as we await results in the Indian election, what if it disappoints? What if Modi fails to get the majority that he wants, the mandate that he wants? How might this play out in the bond market?
So there are three ways or three situations to it that we can look at. One is that there is a number given, the market consensus is there. And if it does not come close to that consensus, then we might see that. But if it's still a majority, then we see that there is going to be a slight volatility. If with the coalition, the majority comes, there could be some course correction or some volatility in the near term, but as the agendas fit in, the longer term gets set in, we will see that again we are back to the track and back to the path that was laid down. But in case there is change in the regime or there is a new government to set, then obviously there will be a sell-off in the market, and the markets would await that what are the new spending going to be there and on what segments are we going to spend, or whether it's going to be more of the revenue expenditure or whether it's going to be more on the infrastructure expenditure. So in the case where there is a failure to set up the current regime, there could be some of the sell-off in the market.
You talked about the RBI's dividend, $25 billion, higher than anticipated. Would that necessarily mean a cut in borrowing in the new budget, you think?
If we have to look at hear the speeches out of the current government saying that once they come into the power, they have like a 100-day plan which is already set out where they're going to spend. But again, like I previously mentioned, that this government has not failed to surprise us, and plus not ignoring the fact that we have 9 months of spending in this fiscal year. Because of the election, we've lost 3 months of spending. So there could be a slight cut in the borrowing on that front, that because of the shortage of the time in this fiscal year, there could be cut down in the borrowings, and probably we see that in the next year, these borrowings could be added to the next fiscal year.
The next RBI meeting, June 7th, how are you weighing the growth and inflation dynamics?
in the next meeting, like the other global central banks are there, we are not expecting much of the action on the rate front. But because of, again, the elections, we have seen that the government cash balances have swelled up, and there has been, the system liquidity has been in negative. So we're expecting some of the action on the front of the rates, on liquidity measures, where they could, shorten their VRR windows, which is, smoothing of the liquidity, or they could formalize some of the actions on the government bond buybacks, or they could come out with a number on the government bond buyback. But as on inflation, right now there would be wait and watch, because we are awaiting monsoon. As of now, it is expected to be above normal, which should be good, but the spatial distribution of the monsoon remains key to us because of the food inflation having a higher allocation in our CPI basket. And on the growth front, we have GDP numbers releasing, which is expected to be around 6.7 to 6.9 as the market consensus, which is coming up. That will still bring our GDP growth above the first estimate, which was at 7.3% to around 7.8 to 7.9%. So RBI will show comfort on the growth front and wait and watch on the inflation front, and take some measures towards the liquidity.
Kruti, realistically, when can we expect the RBI to start cutting rates? I know that central banks around the world are waiting on the Fed, and expectations have already moved from 6, 7 rate cuts to now 1 or 2. How might this impact and shape, perhaps influence the decision by the RBI?
So when it comes to RBI, we have to understand one thing, that where the developed nations had gone on aggressive rate hikes, RBI had not gone for aggressive rate hikes at that moment. So largely to that extent, when there are aggressive rate cuts by the global central banks, that is when we can expect that there could be some of the rate cuts that can be undertaken by the RBI. Otherwise, we would manage mostly through the liquidity operations rather than going for a straight rate cuts, unless and until we are seeing that our growth rates are substantially coming down. But as of now, we don't see that the growth rates coming down substantially.
All right, Kruti, thank you so much for that. Mirae Asset Investment Managers fixed income analyst and fund manager Kruti Chheda. Let's stay with India. The CEO of the National Stock Exchange of India is expecting to see huge foreign inflows after the elections. Ashish Kumar Chauhan spoke to us exclusively from the first UBS Asian Investment Conference in Hong Kong.
The market has taken a sort of a pauser, waiting for the election results to come.
You guys do very well as far as attracting retail investors. And therefore, what do you guys think you're doing well? What are the best practices you think some of the other exchanges in this part of the world can take?
In a way, India is a large country. It's 17% of world population, and it's a highly digital country. The remotest corner of India, everyone has mobiles, and which are smartphones, and very, very nice bandwidth at extreme low cost. So people are able to connect to us. We have now close to 95 million unique investors registered with us.
95 million?
Yes. If we were a country, we would be in top 20 or something like that. Yeah. But effectively, lots more people have come in post-COVID, and also the growth. Young people in India are earning more than their parents at the retirement age because of the way India has come up. And that's where they have more money to spend, but more money to save, and also their parents were investing in physical assets like land or in gold and all. Yeah. Now youngsters want to sort of invest in equities. So that's, I think, a good change that has happened. Financialization is now happening. Formalization of finance is happening with all the high-tech things like direct benefit transfers and sort of e-payments. They've all helped get more people into the formal investing.
Based on the conversations you've had with brokers, is the market expensive?
Currently,
20 times, let's say?
Yeah, people actually discount the future, not the past. What you say today, why something is expensive or not, it's about yesterday's earning and today's price. Whereas what the market is actually telling you is that they are looking at tomorrow's earnings and today's price, right? In case of China, you can see the price earnings is very low because people don't have a hope of earnings going up. So that's where the price earnings look, although earnings may be higher, they think that earnings will go down. While in India's case, people think the earnings are going to go up. So
you're saying that China doesn't have a visible earnings growth story?
It is their investors. Their investors think that the earnings will continue to go down year on year. And it cannot be like a blip for a year, but like on a 10-year scale, 20-year scale, that's what people...
There's a premium being built in into the market. What's the sense you're getting from investors here? Because it's the same group of investors that have taken money, allocations from China, cyclically and tactically taken them to India, and might be pulling that out of India now that the Chinese market is starting to come alive.
China has, in a way, last 3 years also, China has kind of promised quite a lot, and then it has not performed because China is actually a much larger market in terms of the numbers. And each time people have, like post-COVID, people had a feeling that there's going to be huge growth. It didn't come out and they had to lose money in a way. Second part, I think people are worried about whether if they make money, whether it will come out or it will be allowed to come out or not. So that's also an issue. Well, as I met a few investors yesterday, today also I have some meetings. What they tell me is that post-elections in India, there's a huge amount of, the results, huge amount of money waiting to come in.
National Stock Exchange of India CEO Ashish Kumar Chauhan speaking exclusively with the China Show co-anchor David Inglis. Of course, Ashish Kumar was pretty confident that they'll see a lot of money coming in. Plenty more ahead. Keep it here with us. This is Bloomberg. India kicking off its trading day 1 minute into the trading session. Here's how it's looking for its benchmarks. Pretty much gains. Tepid gains, but gains nonetheless. Sensex index up 0.2%. We have the Nifty Bank index up by 0.2% as well. Of course, India trading at high valuations. And according to the NSE Chief Executive Officer Ashish Kumar Chauhan, those high valuations are a reflection of tomorrow's earnings at today's prices, just like what we saw for Japan as well as China and Europe. In terms of the rupee, trading at 83.1175 versus the USD flat at this point in time. It's strengthened by the most in 5 months as Indian stocks hit record highs. Now, since time, co-founder Xu Bing says the firm is aiming to be profitable in 1 or 2 years. We spoke with him earlier and asked about their new AI offering.
SenseNova is our answer to ChatGPT, our answer to GPT-4. So we are a company of 10-year-old. We're not a new company. We started in 2014 with the help actually from NVIDIA donating 80 GPUs to us. We used to be the earliest Chinese research team that did a lot of paper on deep learning and computer vision. And we started a company in Hong Kong and they go set up offices in Beijing, Shanghai, etc. So we listed our company a little bit more than 2 years ago. It's been 10 years for us. This year is our 10-year anniversary, and we released our newest models to compete with the best models in the world. And of course, we know that there will be a GPT-5 or even GPT-6 coming up. And we're also still trying to make usage of the resources that we have to remain catching up. So historically, during the past 10 years, we raised $6 billion in total in terms of capital, and we are a big investment. We are actually a big investor in NVIDIA chips. So we bought more than 40,000 NVIDIA chips during the past 10 years. And we leveraged those chips to train all kinds of models, computer vision models, large language models, diffusion models for generating images and videos. So we're trying to put those models into products and also release it to the industries in Asian markets.
So you mentioned a couple of things. Let me pick up on your plans to monetize them? Because it's the competition, as we know, in China is quite fierce. Do you have any specific targets for this specific AI model, for example, or others?
Yes. So firstly, we believe that the AI represents the future for the next decade or two. The one that having a leadership in AI technology will be attracting a lot of customers to work with them. So I see that already in the US. A lot of customers working closely with leaders like OpenAI, like Anthropic, and I believe that in the Asian markets, there will also be leaders as well. So we try to be that leader. But of course, there are shortage of resource here in Asia in general. For instance, the shortage of compute. I think in general, it's like a 10 times of gap of the compute resources that we have here compared to the US leaders. But I think Asian markets never lack of talents and never lack of data. So in terms of talents and data, I think eventually we will also be able to, even though that we have lack of compute, we're able to, make sure that we squeeze the last bit of the compute and then, try to be the.
And that was SenseTime co-founder Xu Bing speaking with David Inglis just a little earlier at the UBS conference. Plenty more ahead. Keep it here with us. This is Bloomberg. Well, much of South and Southeast Asia have been sweltering under a severe heat wave, one that has caused power outages and deaths across the region. It is a problem aggravated by a changing climate and poor urban design. Bloomberg's Paul Allen has more.
For 2 weeks now, Karachi's 15 million residents have been baking in a heat wave. Temperatures in parts of Pakistan have been nudging 50 degrees Celsius. That's 122 degrees Fahrenheit. Surrounded by concrete, which stores and radiates heat, Karachi has become a giant oven.
Basically, we have turned Karachi into a concrete jungle, and I think green cover of Karachi is hardly 5%.
Hospitals have been treating hundreds of patients for heat stroke, keeping them cool made more difficult by frequent power cuts as the electricity grid buckles under the demand. It's a crisis that ignores borders. In neighbouring India, rivers in Maharashtra state are dry, wells are running on empty, and farmland is parched. The only point in pumping this well is to illustrate how nothing comes out of it. A typical farm worker here earns about $4 per day. At the moment, all they can do is helplessly watch as crops die.
I will not allow my children to join this profession because I believe farming cannot be enough for our monetary survival.
The brutal conditions are being felt in much of Southeast Asia as well. Rice planting in Thailand and Vietnam usually starts in May. A water shortage is stalling that and is part of a longer-term trend.
The next 2 decades where the temperature will be increased around 1 up to 2 degrees Celsius. The rice production will be dropped around 10 up to 13%. Thailand will be export less amount of food to the world market. And that will have the implication to the global food security.
India, Pakistan, Thailand and Vietnam are the world's top 4 rice exporters. The parts of the world dodging this heat wave now may not dodge the consequences of it. Paul Allen, Bloomberg.
Sweltering heat in this part of the world. In the markets, we're keeping a watch on China property stocks in particular and further easing measures to support the sector. In fact, Shanghai cutting its down payment ratios as well as the minimum mortgage threshold. Bigger Chinese cities following through on the government's call to support the property sector. China Vanke are currently up by 0.3%. Shimao property higher by more than 5%. We're also keeping a watch on China copper stocks in particular. Copper resuming a rally along with other base metals to recover some of last week's slump, and that's on the back of China stepping up efforts to rescue its property market and a weakening US dollar boosting demand for the outlook as well. Copper currently up by 1.5%. In fact, BHP Group is flat as we speak. Overall, the market in wait-and-see mode as we await that CPI print pretty much across the board in the world. Of course, Fed front and center. Take a look where we are in terms of the CSI 300 index, under pressure as we speak. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.